Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this week's Monday Minute live chat hosted by the Canadian Leadership Congress. Today, we're discussing decarbonization and the future of global infrastructure. And here to talk about this topic with me, I have Shane Hurst, who's Managing Director, Portfolio Manager with ClearBridge Investments, a Franklin Templeton company. Welcome, Shane.
Thanks, Caroline.
Excellent. Well, let's dig right in and get some context about the evolution of infrastructure in the context of asset owner portfolios over the last decade. How has it evolved, and what approaches do you see asset owners considering a bit more right now?
Yeah, so thanks, Caroline, for having me, and thanks everyone for listening in. Look, I think there is clearly a continued recognition that infrastructure assets are essential services, and their role in their portfolio is quite different to those in industrial companies that are more leveraged to the business cycle. What do they provide? Well, they provide stable cash flows and dividends underpinned by regulation and long-term contracts. They provide an inflation hedge, diversification, certainly versus other asset classes, and then access to a significant amount of thematic drivers, including the move towards net zero, which I'm sure we'll talk about a little bit later, the mispricing of listed and unlisted, and a bunch of other very strong key thematics going forward. So whether or not it is a listed holding or an unlisted holding, I think they have those exceptional defensive characteristics. And really, it's all about your definition of infrastructure, which really guides what type of outcome you're likely to get.
Okay, and so how do you define infrastructure?
So in terms of our definition of infrastructure, what we aim to do is deliver those very stable returns, those stable cash flows, those growing dividends to investors. And so to that end, it's really important to exclude those volatile cash flow assets. They are your energy retailers, your E&Ps, your logistics type businesses, those unregulated businesses that have supply and demand risk. What do we include? Well, we include regulated and contracted utilities. These are your water, your gas, electric type utilities that have a regulated asset base, a cost of capital that's determined by the regulator, a pass-through of inflation, and are of course very highly defensive. When it comes to user pay assets that we include within our definition, these tend to be your airports, your roads, your rail, your ports, and these are user pay assets that are very much leveraged to the growth in the economy. They still pass through inflation. They are still on very long-term concession contracts. And importantly, they still are able to deliver those very stable cash flow outcomes that we're after, really.
So you've mentioned ports, airports, inflation on top of that. I have to ask you, in your view, how did the pandemic impact some of these global infrastructure investments?
Yeah, so look, it's an interesting one. You go back really over the last 2 to 3 years, it's been a net positive, and I'll just talk about it a little bit why. I think the first point is, if you go to the marginal negatives that have come out of the pandemic, well, there was definitely a slowdown in road, rail, and airport spending back in 2020. As the pandemic hit, obviously traffic in those assets dropped right off, and so spending and capital spend really tended to fall off as well. But there were a number of positives that came out of the last 2-3 years. The first is greater spending on midstream and energy infrastructure assets. Obviously, the demand for commodities has increased, and you know that there in Canada. And as a result of that, there's been greater amount of energy infrastructure spend on capital and on capital projects. You have also seen spend on hydrogen and carbon capture backbones, especially in the west coast of the US. I think the biggest positive that's clearly come out of the last 2 to 3 years is the greater spend on decarbonization, and with 36 trillion US dollars expected to be spent between now and 2050, there's substantial upside, certainly to the companies that we invest. So, for assets we invest in, there is These are very much liquid assets. These are large assets, and these are assets that are very, very stable and deliver those stable outcomes.
Yeah, I want to pick up on your reference to the new bill in the United States. What kind of opportunity does this general push for net zero globally, and more specifically, the new US bill represent for infrastructure?
Yeah, so there's no doubt to us, net zero is the biggest opportunity within our asset class at the moment, and so really there's no better way, we think, to access that theme through global listed infrastructure. In fact, infrastructure assets in general. As I mentioned, massive amount of spend, $36 trillion of clean energy spending to 2050. $16 trillion is actually expected to be spent by the networks, which then gets wrapped into an asset base, and we earn a regulated return off that. So, massive amounts of spend. And just to throw out a few extra interesting stats, there's a hell of a lot that needs to be done over the next 7 or 8 years. And just to put that in context, if you look at power spending, it needs to increase to roughly 2.5 trillion per annum. There needs to be a massive ramp up in wind, solar, and other renewables. So we're talking about almost a 6-time increase. And the other thing that really needs to happen is the use of electric vehicles. So, currently about 10% of vehicles globally are electric. And that's sold vehicles are electric, and that's likely to increase to about 60% by 2030. So there is a massive opportunity there, and there's a massive change in social views on these issues as well. To the IRA bill or the Inflation Reduction Act, which was recently passed, again, that has been a massive positive for the companies that we invest in. They get greater policy certainty, as I'm sure we'll touch on a little bit more later, with tax credits, whether they be production tax credits, income tax credits, assets like nuclear assets in the US, which are absolutely essential for the move towards net zero to guarantee that very stable generation load, have now 10-year guarantees or subsidies in place. And there's also huge incentives in areas like hydrogen production, which could actually see the US globally become a leader in this area. So, certainly we think it's very, very positive. And from our perspective, the best way to play it is through those very stable infrastructure and utility assets, because you don't take that technology risk.
Yeah, so clearly in the US, public policy is evolving to really support the building of some of this infrastructure. But how important is it broadly and more globally in incentivizing the kind of innovation and technology that's needed to do all of these things you're talking about?
Yeah. So look, it is probably the most crucial part of the puzzle, I guess. And to your point, the best example is climate change. So we look what's happened over the last 2 to 3 years. Globally, you've had something called COP26, which saw 109 countries pledge to slash emissions. You saw developing countries commit to net zero targets. And then you also saw countries phasing out deforestation and stuff like that. So really there was, huge, I guess, global support for the move towards net zero at those types of forums. Regionally, you've seen similar types of incentives and commitments. So we just have to look at places like Europe, which came out with Fit for 55. That was really an acceleration of their move towards net zero by rolling out more renewables and retiring coal and gas plants. And that's obviously necessary, especially with what's happening with gas flow into the continent at the moment. And then we've obviously talked about the Inflation Reduction Plan, which clearly in the US will continue to be a positive. So really, all of these public policy pledges and incentives really create opportunities for investment in infrastructure and utility companies. They facilitate that move towards net zero, and they really encourage that innovation, which will lead to, firstly, I think, a faster move towards a net zero outcome, but also a move at a lower cost, which is obviously crucial to make these moves commercial. If we look at individual companies, and I'll just throw in two which I'm familiar with and you'd be familiar with. If you look at Australia, Australia is pledging to move towards net zero by 2050, 45% cuts in emissions by 2030, with a 20 billion Australian dollar low emissions technology fund, which has really started to spur a huge amount of investment and proposed investment. You look at Canada, and they do have the Emissions Accountability Act, and the plan essentially cuts emissions by 45% by 2030 from 2005 levels, and they have ambitions to hit net zero by 2050. That includes, items like mandates on electric cars, retrofits of buildings, but there are still some key elements that need to be worked out in Canada, such as what happens with emissions capping, clean energy standards, and carbon capture. So, look, again, the opportunities for our companies, the opportunities for listed infrastructure companies to invest with public policy support is certainly creating greater growth in our assets. And it also lowers ultimately the cost for customers, with our companies still able to achieve very attractive returns on equity.
So Shane, you're in Australia. I'm in Canada. We're two resource-based economies. And any thoughts on how, say, Australia is managing to balance this energy transition with the large portion that resources play in your economy, similar to Canada?
Yeah. So look, I mean, you're right. I think I looked this up recently. About 24% of Canadian exports are essentially resources, and in Australia, it's far larger. So Australia is heavily dependent on the export of resources and all types of resources, really. I guess advice, for what it's worth, would be to work with what you have. If you look at what Australia is trying to do, because it has large tracts of uninhabited land with very hot weather, not at the moment, but often, what they're trying to do is roll out green hydrogen type projects with solar. And so, as an example, there's been 250 billion Australian dollars that have been pledged to develop hydrogen and zero emissions energy sources. So, that's what Australia's trying to do. Offshore wind is another focus. And they're looking to roll out around about 6 gigawatts of offshore wind over the next few years. Canada, I'd say is lagging a little. I was reading an article recently from the Pembina Institute saying there's actually not any sizable offshore wind industry at the moment. They are proposing, I think, 3.6 gigawatts of offshore wind, but certainly, nowhere near what's happening in Europe and the US. I think the other point to make, and certainly we're seeing this through the assets that we invest in, is a lot of the energy infrastructure companies will lead the way in carbon storage and hydrogen projects, and you're seeing that out of the Alberta energy infrastructure companies that we look at in terms of building backbones and other ways to facilitate that move to net zero. In the end, look, strong government policy and commitments need to be made. You need to incentivize that investment, and we are seeing that in both countries, just at different speeds. But no doubt, Caroline, look, you are walking a very difficult tightrope, which will probably mean both countries lag areas like Europe and other parts of the world, which are obviously more leaders.
Well, let's look at that a bit. We've talked about Canada, talked about Australia. Which countries do you think are really leading the way in promoting and investing in the energy transition?
Yeah, look, there's no doubt. There's no doubt Europe is the one that's leading. And if you look at the European Commission estimates, they expect a further 350 billion euro to be required in order to hit that 55% EU greenhouse gas emissions target by 2030. So that takes really investment up to around about 1 trillion euro. And why? And I guess the obvious question is, why are they leading? The first point is necessity. They don't have much in terms of natural resources, and as we've seen in the case of Russia, they want to become far more energy independent. So the way to do that is to use what they have, as I mentioned before, and kind of roll out more renewables and invest more in hydrogen and other cleaner sources. I think the other point is clearly politics. Large European bloc countries such as Germany have strong political support from their green parties for decarbonisation, and that's clearly been one of the areas where you are seeing a greater push in public policy. I'd say it's the other interesting one to look at is the US. Now, the US obviously do have a plentiful supply of gas. They are pretty much oil independent, aside from some of the oil they move from around the world, including places like Canada in terms of their imports. But some of these incentives that came from the recent plan are substantial, right? So if you look at the hydrogen tax credit, it actually makes green hydrogen very, very close to parity. So green hydrogen is hydrogen produced from renewables energy. It puts it at parity with some of the dirtier productions of hydrogen, such as grey or blue hydrogen, which still needs to be worked out. So grey is the production of hydrogen from gas plants. And so you could see, and this is honestly conceivable, you could see over the next 5 to 10 years, the US become a leader in the production of hydrogen. And that's quite amazing when you think of where they've come from over the last 5 to 10 years in terms of public policy support.
Yeah, that is a fairly stunning leap. Where are the risks right now that you see in global infrastructure, especially in this, I suppose, probably quite rocky move to a net zero economy?
Yeah. Look, I mean, there are clearly risks. There's a huge opportunity, but with every opportunity, there are risks. I think the first one, which we've seen pick up lately, but it's still a risk, is public policy support and the fact that that could falter. Commitments set up at COP26 and other climate change forums may not be adhered to. Especially in emerging markets countries. You could get a change in government in the US, as an example, in 2-3 years' time, and that could then go through a process of trying to repeal some of these very, very positive outcomes that have been released through the IRA plan. I think the second very big risk is climate inflation, also known as green inflation, and that's the increased cost to facilitate the move towards net zero. How that manifests is a difficulty to pass through higher costs and higher inflation to the ultimate consumer. Now, those increased costs could come through the rollout of renewable assets. They could come from the fact that we haven't been investing in more hydrocarbon-based oil and gas assets for a number of years. The costs have actually gone up, but the biggest issue is their ability to pass through that higher cost. And if they can't do that, that's clearly a risk. Everyone knows about this through the COVID period, but clearly supply chain issues and material delays will put pressure on the outcome. You're seeing that around the world where you've seen 6 month to 1 year delays in accessing wind farm equipment, solar equipment. You've seen legislation in the US, anti-dumping legislation, which really works against importing goods from China. So that's also a risk. Unstable grids. In the end, we have to remember to generate a very stable outcome in terms of electricity to people's homes. You don't just need renewables and solar, which are obviously more intermittent, they don't operate all the time, you also need stable generation such as nuclear, gas, and then ultimately batteries, which will backfill some of that intermittency. So that's, you know, certainly another challenge. And then finally, investors taking on too much risk. So, you know, by allocating too much to the technology side of these assets, which we don't invest in, but obviously that's where some of the incentives are pegged. There's a possibility you will get greater volatility, investment that doesn't generate attractive returns, and then negative outcomes, which is what we don't really want to see when we're trying to move towards a net zero outcome by reducing hydrocarbon dependence.
Yeah, no, that's a really good point. So there's a lot of money needed here. I think you mentioned it somewhere in the trillions. Where's this money going to come from? And are you optimistic that we can find that amount of capital or raise that amount of capital?
Yeah, so look, it needs to come from the private sector ultimately, especially in developed markets, whether it be equity or debt. But the private sector needs to be comfortable they'll make an adequate return on their capital. And so, you know, according to the IMF, global climate finance currently adds up to about US 630 billion annually, with most of that coming from debt funding. As we move forward, that'll have to substantially increase, and we'll also have to see a lot of that increase come from equity finance. And we've seen, whether it be unlisted strategies and unlisted funds raising, you know, billions and billions of dollars to fund the move towards net zero, or listed companies, we really have seen that commitment. If you look at our utility companies globally, they are committing hundreds of billions to decarbonize grids and achieve that net zero outcome. And they're very comfortable that these investments will generate, you know, 8 to 12% returns on their equity under regulatory constructs rather. So, you know, the ability to get very attractive returns on equity off their investments ultimately. So the key continues to be, and we've talked about this a number of times, Caroline, the key continues to be policy certainty. We're seeing this around the world. We're clearly in the early innings, but I am very optimistic that capital will flow from all sources in order to work towards a net zero outcome.
I like ending this discussion on an optimistic note.
Yeah.
Thank you, Shane. It's been a terrific conversation. I really appreciate you taking the time to speak to us today.
Thanks, Caroline. Appreciate it.
So that wraps this week's Monday Minute. Don't forget to send us your questions and we'll get back to you right away with our speaker's response. And we've got a lot of exciting content and great interviews lined up for the rest of the year that you won't want to miss. So be sure to hit like and subscribe buttons below and visit us at leadershipcongress.ca to get our informative CLC newsletter. Thank you for joining us today and see you next time.